If you are a property investor in New Zealand, you're probably very frustrated like myself. There's so much new rule going on and so confused. One of the new rule that about to take effect is loss ring-fencing rules. And in this video, I'm going to briefly talk about what this rule is and why it's important. By the way, just a little bit warning, I'm not a chartered accountant. In here, I'm just really talking about kind of general information and the effect from your mortgage perspective. If you have further questions, feel free to contact us. But for any in-depth analysis of how that rule is going to affect you, please consult your personal accountant and they will give you professional advice. Okay, so first of all, what is the ring fencing? So ring fencing is basic to say if your total portfolio is in a loss situation, then it's no longer can offset against your other income. Let's have a look at my whiteboard. Okay, say you have two rental property, property 1 and property 2. Every year, your accountant will do a summary financial statement to see if you have any surplus or loss. On the other hand, you probably have a full-time job or you might have a business income. So here's your total income and you'll pay your income tax against that total income. Once your financial statement is ready for the rental property entity, then you might have a loss because of like higher loan balance. As a result, your interest cost is really high, or you have large maintenance costs, etc. Anyway, just to say you have a loss, say 15K, and you have a total income in your household, say 100K. Now, at the moment, before the loss ring fencing rule take effect, you may be able to offset that 15K against that 100K. So you're literally paying tax on the 85 net income. Get some refunds after your financial statement is filed. However, under the new policy, you can no longer do that. You can offset that against your property related income such as capital gain, tax, etc., but you can no longer offset non-property incomes. Let's use a real case study to see the real kind of effect. Then you can probably get a better idea why it's so important. Let's jump onto my laptop now.
This example, let's assume this is a couple. So one is earning 90K, the other earning 80K. They co-owned two rental property. They're getting rents for each property about 30 and 36 grand. So that's the income side of thing. And under direct expenses, they're going to have interest cost, insurance, maybe legal if they just settled, and property management fee, rates, council rates, water rates, and any repair maintenance. And these are the numbers for each property. We can see before above the insurance line, property 1 rental income is not really sufficient to cover interest. But property 2 looks okay. There's still 5 grand kind of surplus. However, if we look at the total expenses, none of the property actually cover enough by the rental income. Therefore, as a result, they make some losses. Now, the total loss across the two is about 15 grand. They will also incur some accounting fee and bank fee, so add another kind of 3 grand. So they're making loss of 17K. Now, under the current rule, they assume their tax code is 33%. Then they are more likely to get almost 6 grand tax refund. That's a lot of money. So their real loss is probably only 12K as opposed to 18K. Under the new rule, what that rule is saying, you can no longer offset this loss against your income. Therefore, you have to find the extra cash that equivalent to the tax refund to keep the same position as before the rule situation. So a lot of people may not have the 6 grand, and if they can't keep up with loan repayments, then they will become a loan arrear situation. And that's exactly what happened during the GFC time. There's a lot of property sold as mortgage sale because they had a cash flow issue. That's the whole reason I want to bring this up, because it's to do with your cash flow, and we have to plan ahead this change and find alternative source, or maybe find a solution to minimize the cash flow shortfall.
Hello, welcome back. So from that scenario, we can see for property investors, if you are already have some loss in your rental property business, it's really important that we need to start planning. Make sure we can find alternative source to cover that tax refund should that law pass. Regardless when the law pass is going to take effect from 1st April 2019. So we only literally have about 20 days left from now to do all the planning. You probably want to contact your accountant immediately, set a meeting with them, and understand exactly how that affects your own portfolio and your cash flow. From finance perspective, I also urge you to contact financial advisor, your mortgage broker, just to find a way to minimize risk. That's exactly what Prosperity Finance are good at. We are spend a lot of time focused on loan structure, help our clients to minimize the risk, minimize cash flow risk, and control by the bank. So welcome to contact us if you're not sure. Finally, if you have any repair and maintenance work that you plan to do for your rental property, you probably want to start now. I hope this video you find it useful. If you know someone would benefit from this video, please feel free to share that with them. They will really appreciate your help. Also, please subscribe our YouTube channel. We have a lot of good contents we put up every week. And if you have any other question, just give us a call. Thanks for watching. See you next time.